Hello, I'm Dr. Smith. I'm a lecturer and writer in the areas of personal finance and investing, and today we're going to be talking about what is a price-to-earnings ratio. But before we get into the specifics of price-to-earnings ratios, we really need to talk about stock investing. Stock investors are purchasing shares of ownership in some company, and they hope that that company does well, because as an owner, if the company does well, then they do well. But how do investors decide which companies to invest in? How do they know which companies are going to do well? Well, nobody knows for sure, but there are many different valuation tools that stock investors can use to help them make buying and selling decisions. And perhaps the most popular tool is the price-to-earnings ratio. In a nutshell, the price-to-earnings ratio provides you with a number that gives you more insight as to what you're actually getting when you buy a share of a company's stock. Unlike most consumer products, the price of the stock alone doesn't really provide you with a lot of information. By computing the price-to-earnings ratio, you'll have a much better understanding of what you're actually getting for your money. Let's look at an example. I'm going to use two hypothetical companies to help me make my point. We're going to assume Zerka Corp currently has a stock price of $200 per share. And then let's assume Biosin, another company, currently has a stock price of $100 per share. Just looking at the share price, it would seem that Zerka Corp is twice as expensive as Biosin. But that may or may not be the case. We don't know what we're getting for the money that we're investing in either of these two companies yet. And the price-to-earnings ratio can provide us with some more insight here. When most investors decide to purchase a stock, they do so because they want to make money in that stock. Well, the investor will make money if the company makes money. And companies will report the money they make in earnings. Now we're armed with the two numbers that we need to calculate the price-to-earnings ratio. The price is simply the current share price of the stock. The earnings will be reported by the company as earnings per share. And earnings per share, or EPS, can be found on numerous finance websites. My personal favorite is Yahoo Finance. Now let's go back to my hypothetical example. Recall that Zerka Corp had a current share price of $200. Also recall that Biosin had a current share price of $100. Let's assume that we go to Yahoo Finance and look up the earnings per share of both companies, and we find that Zerka Corp has earnings per share of $8, while Biosin only has earnings per share of $2. When we calculate the price-to-earnings ratios for both companies, we find that the higher priced Zerka Corp is actually the better deal. Zerka Corp has a PE ratio of 25. When we calculate the price-to-earnings ratio of Biosin, we get a PE ratio of 50. Said another way, when you buy one share of Zerka Corp at $200, you're only paying $25 for every dollar's worth of Zerka Corp's earnings. When you buy one share of Biosin at $100, you're paying $50 for every dollar's worth of current earnings of that firm. So who would ever buy Biosin? Who would pay $50 for a dollar's worth of earnings when they can instead buy Zerka Corp and only pay $25 for a dollar's worth of earnings? The answer is plenty of people. Earnings can change, and the market has priced Biosin at $100 per share because the market believes that Biosin's earnings are likely to grow twice as fast as Zerka's. And who knows, maybe the market is right. When researching companies, you oftentimes find that the more exciting companies tend to have higher PE ratios. They're exciting because of all their earnings growth. In fact, stocks that have a high PE ratio, we oftentimes classify as growth stocks, whereas stocks with a low PE ratio will tend to classify as value stocks. Most investors need both types, growth and value, in order to maintain a properly diversified portfolio. However, growth stocks do tend to be more risky. In investing, more risk means more opportunity for reward, but also more opportunity for heartburn and sleepless nights. Well, that's all for this video. Thanks for joining me, and check back again next time when I'll be talking about more personal finance and investments topics.